Welcome. My name is Evan Unzelman. I am the CEO of CRT Experts, and thank you for joining us for a discussion about using charitable remainder trusts as stretch IRA substitutes. We are recording the webinar for all of our live participants. We'll get an email out sometime tomorrow that will have a link where you can go watch a replay of the webinar, parts of the webinar, whatever piques your interest. A quick overview here at the outset. We're of course all aware that the Secure Act ended the stretch IRA, and today we're going to talk about how to replace that stretch using a charitable remainder trust. We'll talk about the basics, when and how the planning is implemented, who's a fit, who's not a fit, etc. But we'll go beyond the basics as well. And once we've decided that, yes, we'd like to use a CRT to restore the stretch, as we'll see today, not all CRTs are created equal. And we'll talk about how to best design the CRT so that it's maximizing the amount of wealth it's creating for heirs. We'll look at a comparison of a family who uses the stretch, the CRT to replace that stretch, versus a family who does not and just takes the assets through that 10-year window. And we'll use that working example to look at some of these design features that, when it comes to structuring a CRT, that are, in our view, just underutilized. Before we jump in, a quick overview of the team here at CRT Experts. As the name suggests, CRTs are all we do. For several of us here at CRT Experts, we have spent our entire professional lives working with charitable remainder trusts. For me personally, my work with CRTs began in the early 2000s when I was on a team that developed a secondary market for income interest in CRTs and the related buyer pool. It's a topic for another day, another webinar, but the income interest in a CRT is a capital asset. And like other capital assets, it can be bought and sold or used to create a new CRT with different terms, what we call a CRT rollover. That's has always been where I and most of us here have worked the most within the CRT space, what we call CRT secondary planning, reviewing typically older CRTs that are fairly deep into their life cycles. Initially, to make sure the income beneficiaries understand the options and flexibility that they have, and where appropriate, helping them sell or roll over their CRT income interest. The starting point there is always a review of the client's CRT options and that existing CRT. So what that's meant is we've looked at a lot of CRTs. At last count, the team year, we've looked at more than 10,000 CRTs over the last almost 25 years now. That experience really has shaped the way that we approach our work with CRTs today. We spend a lot of time helping advisors design CRT with flexibility in mind. We administer CRTs, particularly more complex structures like income deferral CRTs, CRTs with multi-tier income beneficiary structures, CRTs that hold closely held or other liquid assets and the like. So our work extends from upfront CRT design at the very beginning of the CRT lifecycle. What we'll be talking about here today is creating a CRT that may not be implemented for decades, depending on that IRA owner's age and life expectancy, all the way to the sale or rollover of the income interest near the end of that CRT life cycle, and really everything in between. For advisors, we do not, importantly, we do not manage or custody assets. We do not provide tax, legal, or investment advice. That is by design. We were built to work through advisors, not around them. So unless you're already in the CRT business, we should be a non-competitive resource you can bring in when a client has a CRT planning issue. And that's our goal. Our goal is to be the first call for tax, legal, and financial advisors whenever a CRT question comes up. Located here in Leesburg, Virginia, about 45 miles outside of Washington in Northern Virginia. Okay, so jumping in, the problem we're here to discuss and solve, of course, is that the Secure Act ended the old stretch IRA. So instead of CRT or beneficiaries of the IRA being able to withdraw income over their remaining lifetimes, they must withdraw it over a 10-year period. And of course, those distributions are going to be taxed at the highest applicable rates. So whatever you want to call it, it's effectively a large tax on the IRA after the death of the IRA owner. But however you want to describe it, for many clients, particularly of course those who were planning on their IRAs distributing over the lifetimes of their heirs, this creates a problem. Fortunately, though, with a charitable remainder trust, we have a pretty natural solution. So when we think about an IRA, really at the core of it is tax efficiency. Tax efficiency is what's driving the value of an IRA. We are investing pre-tax dollars in a tax-free account. And even though the Secure Act ended the stretch IRA so that the IRA cannot be stretched beyond 10 years anymore, we can replace it with a charitable remainder trust. So the CRT, like an IRA, is tax exempt. So at the IRA owner's death, the full value of that IRA can go into the CRT with no income tax. Like the IRA, the CRT is able to grow those assets tax-free. So the investment advisor has the benefit of no tax drag on the investments moving forward while they're in the exempt CRT. In fact, we'll look today at structuring CRTs with an upfront deferral period, which is not only are those assets growing and compounding in that tax-free environment, there's no distributions going out. And so that can really accelerate the trust value growth as we'll see. So like an IRA, the distributions to the CRTs are taxable. So that's when taxation enters the equation. Unlike an IRA, though, a CRT is able to distribute capital gain eventually. I say eventually in this situation because unlike that traditional CRT scenario where we're funding a CRT with appreciated property, that's a capital asset, and eventually the CRT is selling that, and that the gain is allocated to the CRT's capital gain tier. In this scenario, when we have a CRT taking in those IRA assets, the IRA assets, the initial value, if it's a $1 million IRA that goes into the CRT, no, that goes in income tax free, but that $1 million is allocated to the ordinary income tax tier. So the way that the CRT distributions are taxed, they're taxed according to it's a 4-tier accounting structure with ordinary income on top. So any ordinary income has to be distributed first. So if we have $1 million coming in to that tier, the first $1 million of those distributions are going to be ordinary income. However, once we go through that tier, as long as that CRT is invested for capital appreciation, which it probably would be, we can eventually distribute capital gain income from the CRT. The distributions are taxed at the capital gain rate. So it takes a while. It's typically 15 to 20 years until we can get through that ordinary income tier. But once we're through that, unlike that IRA that's always going to distribute ordinary income, the CRT can distribute capital gain. So we actually have some tax advantages down the road with the CRT, even when we compare it to the old stretch IRA, which of course isn't possible anymore. In terms of the tax and legal authorities, you can see those up on the screen, very straightforward. During the 1990s, there were several private letter rulings that confirm that a qualified trust like a CRT can be the beneficiary of a qualified plan. And of course, we know that once the assets are inside of the CRT is exempt from tax. So what we've been able to do here is restore the stretch. The CRT is preserving the pre-tax dollars in a tax-free account after the IRA owner's death. The trust is growing tax-free under Section 664, And ultimately, the heirs are getting significantly more money than having to take all of those assets in that compressed 10-year window. We'll look at an example here in a bit to see just how much more. But as you would imagine, this is not a fair comparison when we're comparing maintaining everything in that tax exempt environment over the heirs' lifetimes versus taking them all in that compressed 10-year period. I will say that it's not purely an after-tax value decision in many cases. For many clients, we can model and demonstrate that look how much more after-tax wealth that's being transferred here. Look at these other benefits of using a CRT, which you can see up here on the screen. But for some clients, that's not going to matter. They're just fine with the kids getting access to the money, regardless of the tax consequence. So obviously, those clients weren't going to use the old stretch IRA, and that's not the clients that are going to be a fit here. So to drill on that topic, before we talk about implementation, let's talk about where does this fit, where does it not fit. One thing that is different compared to the old stretch IRA with the CRT is the CRT is a standalone entity with a trustee and its own tax return. And so what that means is that for most is going to put sort of like a floor, an asset threshold, if you will, versus the old stretch IRA. That is not a hard number. We would typically say 500,000 at least. 500,000 to $1 million is sort of that starting point, given that there is a need for trust administration. In most situations that we see, it's several million or tens of millions that are going into this planning. That doesn't mean you cannot do a CRT with $100,000. It's just given the requirement for administration, the requirement for that distribution, you putting that amount into a CRT will often end in a scenario in which the administrative costs just become really prohibitive with maintaining that CRT. So we would generally say 500,000 and up in expected retirement plan assets. Of course, we're looking at this as we get older, 50 plus generally. And these tend to be the tax sensitive clients that view this as a tax disaster, all those assets dropping onto their heirs during that 10-year window. Who's not a fit? We talked on the prior slide, some clients even that have sizable retirement plans, IRAs, this is not something that they're interested in doing. They are fine with their kids getting access to the money regardless of the tax consequence. Of course, IRA owners who expect to use most or all of their retirement plan, their IRA, if we've got $25,000 in IRA assets, this is not going to be a viable solution. We would not ever recommend setting up a CRT with $25,000. So there are some thresholds there that you can generally use to make sure that clients that fit the bullets there on the top have that large retirement plan. We're in many cases planning on using the stretch, tax sensitive, getting older. Those are good candidates, at least to be made aware of this opportunity to replace that old stretch. Before we talk about the implementation, just two important points I want to make. One, the IRA owner must implement during their lifetime. This is not something that we can punt down the road to our executor. I think in some ways that's helpful. This is inertia is always a hurdle with clients on pulling the trigger on planning. So you can't kick the can on this because there's a mortality risk. Once you die, it's too late. Even a client who's 60 years old, who has a long life expectancy that says, well, I'll deal with this later, that's probably fine. But there is a mortality risk because if you do die prematurely, it's too late to do the planning. So we have to take action during the IRA owner's lifetime. So it's always done on a testamentary basis, but as we'll see, it's typically done on a revocable basis as well during that IRA owner's lifetime. Second, CRT design matters, and we'll talk about that. That will bridge us into the second half of the presentation. We'll look at a couple design features that many clients would choose to include when it comes to structuring these CRTs. So how do we implement the planning? There are three general ways that we can do it. We can use a funded trust, an unfunded trust, or what's most commonly used, a testamentary trust. In each of these cases, the result is the same in that we're going to name the trust as the beneficiary of the IRA. So we're going to go to the custodian of the IRA, fill out that change of beneficiary form, and name the trustee of the CRT as the beneficiary of the IRA. So that's an important step. We can put the planning in place, but we have to do that as well. So with these three options, with the funded CRT, so this can be an existing CRT. Most CRTs will allow for future contributions. So as long as the trust instrument contains the right language, that existing trust can be named the beneficiary of the IRA. Why does this rarely work in practice? Even if you have a client who wants to do this planning, who already has a CRT, which is uncommon, but even if that's the case, that CRT they already have is probably not structured the way that these CRTs are structured that are taking in these IRA assets. Namely, their kids, their grandkids are probably not beneficiaries of their existing CRT. They happen to have the same CRT already in place that they would use through this planning. It would work though. So it is an option. We don't see this second option, unfunded CRTs, a lot, but it is an option. So we can create a CRT now, fund it nominally. And these are qualified trusts as far as state statutes, but under the federal statute, there's no requirement for administration, which makes this doable. We couldn't put $1,000 in a trust and afford to pay the administration over the rest of that IRA owner's lifetime. So that does make it possible, but it's that trust has already been created. So we've already locked everything in. In our opinion, what we would typically recommend is doing this through a revocable trust or will. So what that does, like the unfunded trust, once this is in place, there's no ongoing cost until the IRA owner passes and the assets are drop into the CRT or transferred from the IRA into the CRT. That's the effective date of the trust. And so what that means is the IRA owner, there's no ongoing costs, but the IRA owner also has the ability to adjust this planning throughout their remaining lifetime. So if they decide to undo it, they can undo it. If grandkids are born that weren't included up front, they can name those new grandkids. If kids get married and now there's a son-in-law or daughter-in-law they want to include, they can do that. So maintaining that flexibility to adjust the planning, undo the planning with no ongoing costs. For most clients, that's going to pretty easily tip the scales toward that third option. So that's what we typically see in terms of how the planning is actually implemented. Ultimately, we are creating a CRT, and that will get us into the discussion about designing the CRT. So one thing I will say at the outset here, when we're talking about CRT design, in that traditional CRT scenario, I'm sure you've all seen, if you've had clients create CRTs, most likely the goal was they owned appreciated property, whether it was real estate, closely held stock, publicly traded stock. They wanted to sell and diversify that asset, but they wanted to defer the capital gain. So in most of those cases, the donor is the income beneficiary. It's a self-settled trust. And of course, that donor, if I'm creating a CRT and I'm the income beneficiary, I'm going to want to maximize the flexibility that I have under the CRT rules, under Section 664. So that it's a no-brainer in that scenario. But here we're talking about, this is a testamentary trust that by definition, our IRA owners, our donor is deceased. So we're creating this predominantly for children and grandchildren, maybe a spouse. We'll look at that here today. So we're not creating it for ourselves. And so sometimes what that means is that flexibility that we would always implement if we were doing this for ourselves, we may not want to give that to our children as the trustees of the CRTs. So it really, trusteeship is probably the predominant one that we'll see. Some clients want to put some guardrails up in terms of giving the maximum flexibility to the children. They may want an advisor as the trustee, to use a corporate trustee. But we always want to make sure that the client's aware, regardless of the planning context, traditional CRT, stretch replacement, of the design features that we can build into the CRT. And so we want to look at, some of these are obvious. Do you want to maintain the ability to change and make adjustments to the charitable beneficiary? Again, if it's a donor creating that CRT for themselves, almost certainly. If we're creating it for our kids, in most cases, yes, but not always. Sometimes if it's going to the alma mater, the donor advised fund, private foundation, I may not want to give my children the ability to change that. Trusteeship is another one that we'll typically see included, that flexibility. But the top two bullets, design or CRTs that are designed for deferral and maximum duration using what we call a lives plus term structure, those are often underutilized and overlooked. And so I want to hit on those today, but we're going to use a working example. So we're gonna kill two birds with one stone here. We're going to look at a working example that of a case study of a family who uses this planning to replace that stretch versus a family who doesn't. So we can look at what the after-tax value will look like in terms of using it versus not. And then we'll also, because we have a family that's creating a CRT here, we'll look at a couple of these design features and how that would work with an actual example here. We are going to be pretty high level on the duration deferral here, just to keep everything on schedule. If you'd like a deeper dive on that, we've got a webinar where we talked about these in detail. You can see the link up there on the screen, and that will give you probably more than what the amount of detail you're looking for, but it's a very deep discussion on structuring CRTs for deferral and maximum duration. So we're going to look at our working example here. So let's erect that. So we have two families, and both of these families have $1 million of IRA assets. So the families are identical in that sense. The difference is family A is going to take the assets through that 10-year window. Family B is going to use a CRT and replace that stretch. And so we're going to look at how the numbers shake out here for these families. First thing we'll do is look at how we're structuring family B's CRT. We don't always see the spouse as an initial income beneficiary. We'll see why later. Most of the time we do, because it allows us to put a deferral period on the CRT. But our structure here, we have a spouse, 2 children, and 4 grandchildren. And so this is a 3-generation trust. So it's that income stream will go initially to the spouse for the spouse's lifetime, at the spouse's death to the 2 children for their remaining lifetimes, the death of the surviving child. It will go to the grandchildren for the shorter of their lifetimes or a fixed term. And that almost certainly, at least actuarially, unless there's a significantly premature deaths, it'll be for the term. Actuarially, the grandkids are would be expected to significantly outlive the term of years. So this is what we call, and we'll look at the mechanics here in a bit, a lives plus term structure in order to include all 3 generations on that CRT. One thing I want to point out here, this is a different family. This is actually from a case study on the webinar that I linked to earlier. What I want to point out, though, is we can do this planning with multiple CRTs. And in many cases, that is necessary. If we have, in this case, we had 3 kids. But if the more beneficiaries we have, more sort of what we would call a family unit. If we have two children, there's two family units. There's two children and grandchildren. If we have three, like in this case, there's three. And so what that means is we'll talk about the 10% test here in a bit in terms of structuring the CRT, but that will limit the ability, if we're trying to use one CRT, to include as many family members as we want. So we can use three CRTs. In this case, we had $12 million. This was real estate that ended up going into equally into three CRTs. What that does is it makes it easier to pass that 10% test and qualify the CRT. As long as the administration is done under one roof, this should not be more expensive, should not be more complicated for the family. So you do have three CRTs to draft, so it's going to cost a little bit more upfront just to put everything in place. But moving forward, don't let the idea that if we have multiple CRTs, this becomes more complicated, more expensive. It shouldn't, as long as we're keeping all that admin under with one administrative firm. So back to family B here. As I mentioned, to get to all three generations here, we use what we call lives plus term structure. And this really is in the broader discussion of maximizing the duration of a CRT. And generally speaking, what we want to do is we want the CRT's duration, the income period, to last as long as we can. In most cases, that's 50 to 60 years. And we want to include as many family members as we can. When we're doing this, what we're up against is what's called the 10% remainder test. I'm sure many or all of you are familiar. What that means is when based on the terms of the trust, so the ages of the income beneficiaries, the payout rate of the trust, and the current IRS Section 7520 interest rate, based on those, we input all those into software. We'll look at a screen cap here in a second. Based on all the terms of the trust, at least 10% on a present value basis of what goes into that trust needs to be projected to go to charity. This is just an upfront test. It's just what's projected. It doesn't mean that 10% actually has to go to charity. This is just an upfront requirement or a test that we have to pass. And ultimately what that does is it constrains or limits the duration that we can put, how long we can pay out from that trust, and or the payout rate, the distribution rate of the trust. And whenever we talk about lives plus term CRTs, we often will get that eyebrow raised. Wait, how are you doing this? You can structure it for the lifetimes or a 20-year term. So this is not technically lives plus a term. This is technically lives plus the shorter of additional lives and a term of years. And that's the key distinction here. So the regulations you can see up on the screen, the regulations require that a CRT may not extend beyond the life or lives of a named individual or individuals or a term of no more than 20 years. Therefore, a CRT can be structured to pay for lives of certain named individuals, followed by payments to other named individuals for the shorter of a term of years not to exceed 20, and the life or lives of those other individuals. So the key here, the trust cannot last beyond the lives in being at the date the CRT is created, and we are not running afoul of that requirement. So in Family B's example, you can see we have a surviving spouse that's 84, two children that are 59 and 56 years old, and we have four grandkids that are 34, 31, 28, and 26. The initial spouse, this trust was structured, it's a 5% payout rate. We're typically going to use that 5% rate because what that's going to allow us to do is extend that term for the term beneficiaries, the grandkids here, for as long as possible. So in this scenario, we'll go to the spouse for the spouse's remaining lifetime, then to the two children for their remaining lifetimes, then to the grandchildren for the shorter of their remaining lifetimes, and a 17, well, we'll see, and a term of years. And so if it's highly unlikely to happen, but if the grandchildren all die prematurely before that term is up, that would end the trust. But most likely, in these cases, just based on life expectancy, the term beneficiaries are expected to outlive significantly that successor term. So when we are determining or figuring out how, what are the maximum, what's the maximum payout rate? We're typically going to put that at 5% to allow for the maximum term. And so when we're determining the maximum term, that we're going to use software. So there's lots of different software out there. Software is not created equal, just like CRT design. There's some software won't even run calculations for this structure. Most now does. We use two versions of software here. One version that we use will calculate lives plus term, but it will only allow for two beneficiaries, lifetime beneficiaries for some reason. This software you can see up here on the screen if you're familiar. This is it's called Easy Charitable. It's Lee Hoffman. It's his software. This is what we found to be the most robust and comprehensive in terms of software. So you can see what we're doing is we're loading in all of our assumptions here. So we've got the ages of our three lifetime income beneficiaries, the spouse and the two children, and then the ages of our four grandchildren. And what we're going to do is we put that payout rate at 5%. That's the minimum payout rate we can use. And we're going to start that successor term to the grandkids at 20, because that's our maximum. And then if it fails, like it did here, we have to start pulling that term back. And so you can see here where we passed that 10% test was at 17 years, 10 months. So almost 18 years. And you can see there's that key figure down there. That has to be at least 10%. So, I mean, this software will let you take it up to the day if you wanted. But typically we'll do just the nearest year, the nearest month that maximizes that term and still passes that 10% test. Okay, so now where the rubber meets the road. So let's look at how these two families, how the numbers come out for these two families. Family A just takes it all through the compressed window. Family B uses a CRT to restore that stretch. This is an overlay. Typically, I would go graph by graph, but to keep us on schedule, we'll just look at the overlay here. So what are we looking at? So this graph is comparing our two families using a CRT compared to withdrawing during the 10-year window from the IRA. So the solid green is the value of the CRT account. So that's the investment account. It's distributing 5% each year. And the vertical green lines that you see is the distribution each for that year from the CRT. The solid red line is the IRA. So that's distributing all of its assets over that 10-year period. And the dotted red line shows the value of the money withdrawn from the IRA after taxes and spending that is reinvested. So to keep this apples to apples, the heirs are spending the exact same amount in each scenario. So we are withdrawing from the reinvested IRA account the same amount that the heirs receive from the CRT. And what we're withdrawing from the IRA account is the vertical red lines that you can see. So eventually, under the withdrawal from IRA scenario, the money is all gone. The CRT keeps going. Ultimately, it's more than double the amount of income. That immediate tax hit on the IRA is just too much for that strategy to overcome when we're putting it up against a CRT that's maintaining everything in the tax-free environment. As I mentioned earlier, it's just not a fair comparison. And for many, I wouldn't say many, for some clients, we can show them this, like I mentioned earlier, how much more money they can pass, but they're just focused instead on their heirs getting access to that liquidity right away, even if it comes at a dear tax cost. So that's our first comparison. what I want to do now is I want to look at a design feature that we see a lot, regardless of the scenario, a traditional CRT or the stretch replacement CRT, and that is putting in upfront deferral period on that CRT once it's funded. And so I want to look. It will look at what exactly. Oh, glad I put this little arrow reminder here. Before we jump over to that, as I mentioned earlier, so we had that the $1 million goes into that ordinary tier. We've got to burn through. We've got to distribute all that out first before we can get down and distribute capital gain. But unlike the old stretch IRA, the CRT can eventually do that, and that's what you're seeing here. Is year 18 is where we've gotten through all that ordinary income, and we can start distributing capital gain. And you can see accordingly, we see a little jump in that after-tax income because the effective tax rate on that distribution is lower. Okay, so as I mentioned, in many cases, if you think about some of these clients that have these large IRAs, in many cases, even though there's a spouse that's expected to outlive the IRA owner, in many cases there's just not a desire for income to the spouse either, just based on the family's just financial situation. So in many cases, again, whether we're using a traditional or the stretch replacement, the CRT is structured for deferral. And we're going to put a deferral period up front on that CRT's life cycle once it's funded. To allow for deferral, we're going to use what's called a net income with makeup CRT, often called a NIM CRT, as I'm sure many of you are familiar. So a NIM CRT will distribute the lesser of a stated payout rate and trust accounting income. So unlike a standard CRT that's going to distribute that payout rate each year, regardless of its income, with a NIM CRT, there's a net income limitation. It's never required to pay a beneficiary more than its income. So if it doesn't have income, nothing has to be distributed. And there's this makeup provision that enables us to pay unpaid or deferred amounts in future years. So that income exception and makeup provision can be used to control the timing of distributions from the NIM CRT to the beneficiaries. So again, if you're interested, that webinar that I put up earlier will give you that deep dive. But this is just at a high level. This is all centered around trust accounting income. So trust income is a cash concept. So and what that means is that the trust will not have income if it does not have a cash receipt. So there are several techniques to control the timing of trust receipts. And thus when a NIM CRT will have trust accounting income, but they all work generally the same way. The investments are held in what's often called a container. And sometimes that's an annuity, it could be a partnership. Today, it's usually a single member LLC wholly owned by the NIM CRT, which is most often what's utilized. There's advantages from a tax and administrative standpoint to an annuity or partnership. So that's what's typically used. But regardless of the container that's used, until we distribute cash from that container to the NIM CRT, we don't have trust accounting income that has to be distributed. So the interest, dividends, realized capital gains that would need to be distributed if the NIM CRT owned the underlying assets directly, those are still incurred. They're still tracked on the CRT, on the 5227. But because trust accounting income is not triggered until cash is distributed from the container, we don't have to make any distributions. So that's high level, obviously, of how it works. There are, of course, many technical details that we have to address that goes beyond the scope of this discussion. But again, you can see that discussion on that CRT design webinar that I linked to earlier. So let's now look at, I want to go back to family B. So same comparison, no change to family E or A. They're taking the IRA through that 10-year window. What I want to do here is show the impact of putting this deferral period on on the CRT's life cycle. So in this case, we have that spouse up front, same ages, everything's the same. We're just going to assume that spouse elects to defer income. There's a deferral period equal to that spouse's life expectancy, which is about 10 years. I think she's 84. So what that does, as you can see here, is there's no distribution. So as I mentioned at the outset, not only do we have the assets in this tax-free account, this tax-free environment, we're not making distributions either. And so that initial deferral period can significantly accelerate the trust values or the trust value growth. So delaying those distributions, I think of it a lot or explain a lot. It's like a runway to take off. That early deferral can really boost the long-term value. It just allows those trust assets to compound more rapidly over that deferral period. So you see here, we have that 10-year deferral period that increases that trust value growth. And then at the spouse's death, now we're distributing that same 5% over the same lifetimes and term, but it's on a higher trust value. And so that, of course, is going to lead to, in this case, a significantly more income. So it was $3,586,000 without the deferral period. That increases to north of 5.2 million with the deferral period. So as long as there is the ability and desire to defer, this can make a lot of sense if that's the goal, is just maximizing overall after-tax wealth. In some cases, that's not the goal. In some cases, we want to get the assets to the kids right away, still restore the stretch. So it's still a lifetime CRT for the children and maybe the grandchildren as well. But we want to distribute it all the way. In some cases, we may go straight to the grandkids. We may go only to the children to get a higher payout rate. There's a lot of different ways we can take the CRT design. The key, of course, is just making the client aware that this exists and then uncovering what their objectives are. If we do this through that test, the revocable trust or will, we can maintain the ability to adjust that planning over the IRA owner's remaining lifetime. We can see here, because we have that upfront deferral period, that is going to push out the duration or the period over which we have to pay that ordinary. So you can see here, it's year 20 is where we've finally gotten through that ordinary, and we can start distributing capital gain. So different situations where we would also see maybe a desire to use multiple CRTs, even if we still have our same family. So we know we can do this planning with one CRT, but let's say that it's expected that one child is in a position where they would want the income and the other child wouldn't. It's possible, but difficult to do with one CRT. So what's simpler is to use two CRTs. And we can even structure both for deferral, but one very likely, if we've got the client that wants the income, is going to start distributing right away. So we wouldn't have that deferral period where the other would. We've seen situations where it's expected that child is going to fully defer. And so that's ultimately maximizing what's going to be distributed to the grandkids over their term. So lots of different scenarios. One consideration when we do use two CRTs, though, we have more mortality risk. And so we have, instead of having the lifetime income stream before that term to the grandkids tied to the spouse and then two children's lifetime. So if one of the kids dies prematurely, it's still going. If we do this 50-50 with two CRTs and one of those kids dies prematurely, that's going to start that term to the grandkids. So there is more mortality risk there. If bloodline's not a huge concern, it often is, but if it's not, and there's a son-in-law or daughter-in-law we can include, we can reduce that mortality risk. So again, lots of different ways we can take the CRT design, but in any of these scenarios, we're accomplishing this higher level objective of restoring that old stretch that the Secure Act took away. So I'll put my contact information up on the screen. Obviously, if you have questions, let me know. But just to put a bow on our discussion here today, we've used the CRT to restore the stretch. This has to be done during the owner's lifetime. As we saw, there's different ways of doing it: existing funded CRT, unfunded CRT, or most commonly through irrevocable trust or will. There's different considerations we need to make as far as how we're structuring the CRT. We need to take advantage of what that IRA owner, what that donor wants us to take advantage of, to maximize what they're looking to maximize. So hopefully this has been a helpful overview for everyone. Again, any questions, stretch replacement related, administration, selling an income interest, CRT rollovers, any CRT question that pops up, don't hesitate to reach out to us. As I always say, we will nerd out on CRTs anytime, even if it's not a potential engagement for us. We love questions about CRTs. We should be able to answer those on the spot. But if we can't, we'll certainly get you the answer. So please view us as that CRT resource whenever a CRT planning issue comes up for a client. We want to be your first call, your first email. So please don't hesitate to reach out. In the interim, again, thank you for joining us. I hope everyone has a great rest of the week, and we will hopefully hear from you sometime soon. Thanks again.